In this video, we would be talking about the capital asset pricing model in corporate finance. So hi, I welcome you all to DevTech Finance and let's get started with this video. Starting with a basic introduction of CAPM. So CAPM stands for Capital Asset Pricing Model. This is a model which is used to calculate the cost of equity. So we mostly use this model to calculate the cost of stock. And see why it is important because when you are raising your finance through equity, you need to know how much you need to pay back to your investors, how much is the minimum required return which you need. So that's all is involved in the cost of equity. You need to understand what is the minimum hurdle rate to be crossed, and CAPM helps in representing the expected or required return from an investment in asset as compared with the risk involved. So CAPM takes into account the expected or required return, what the return you are expecting out of the investment in that asset, and how much risk is involved. It takes into consideration both the things. This model takes into account the asset's sensitivity to market risk, often represented by the beta, as well as the expected return from the market and the expected return from a risk-free asset. So when we would see the CAPM formula, we would get a more clear picture about what these things are, why we are taking into consideration the market risk, the beta value, and the risk-free asset. So CAPM is used to calculate the cost of equity, and that would help in pricing of the asset and generating the expected return out of it. This is one of the most widely used models to calculate the cost of equity, but it is not the single model which is used to calculate the cost of equity. There are other models as well, like the multi-beta CAPM, the dividend discount model, the arithmetic average historical return, or just by simply measuring the investors' expectations from the equity. So these all things are taken into consideration. Let's move forward and look at the three most important inputs in the CAPM formula. So the first one is the risk-free rate, and this risk-free rate is the interest rate arising from any of the secured assets. Like if you are investing in the government bond, in the government security, or in the bank fixed deposits, what would be the rate of interest which you would be getting? So whenever you make an investment decision, you first try to measure that you need to have more than the risk-free rate. So these risk-free rate are the interest rates by all the safer and the less riskier sources. So you, by trying to invest in the equity, you are expecting a higher return because you are avoiding all those assets, all those bonds and government securities which provided you a lower return but a more safer option. It was, you are taking higher risk, so you are wanting now a bigger return as compared to them. So it's very important, it becomes important to take into consideration the minimum required return above which you are expecting something. Second is the beta value. Beta we already discussed in our previous session. It shows the sensitivity or fluctuations in the asset. It takes into consideration not just the individual risk involved in the asset in which you are investing. It tries to compare. It tries to compare it with the market risk. So if the beta value is say 1.20, we understand 1.20%. We understand with 1% change in the market, your asset is changing by 1.20%. So this is what beta value was showing, how much sensitive your asset is as compared to the market fluctuations. And then there is expected market return. So you always estimate some expected return if you're making an investment. That expected return which you want out of your investment in that particular asset in the stock market, that is expected market return. You may take this into consideration by having an estimation based on the previous prices, based on the market scenario, based on the different assets in the stock market over there trading in the same. Let's have a look at the formula for CAPM. So the formula for CAPM is like expected return out of the investment would be equal to the risk-free rate plus the beta value into the expected return from the market minus the risk-free rate. Now let us try to understand it one by one. So expected return from investment. If you are making an investment in a particular stock, in a particular equity, what is that the expected return which you want from that investment? And how is that calculated? So we takes into consideration the first thing is risk-free rate. As I told you, this risk-free rate is the it gives you the idea of having at least what you could have got by investing in any of the secured government bonds or the fixed deposits or the government securities. Now the idea behind the risk-free rate is the least that you would require for the loss of purchasing power because of the inflation. You know that with the changing time, with the passing time, there is inflation rate involved. So the money, the purchasing power of the money which you are holding at this period of time won't remain the same after several years. It would decrease. So you want at least that much. This is the whole idea behind taking consideration the risk-free rate into the CAPM formula. The third one is the beta, and we understand the beta gives you a more realistic picture because it's not only compared the individual risk involved in that asset, it's single fluctuations, but it takes into consideration its fluctuations as compared to the market fluctuations, how sensitive it is as compared to the market. So if the market is going up, how is your asset moving, so that you can have a clear picture on your asset and the market movement. And we also looked at the beta formula in our previous session, which was covariance by variance, where the covariance was the return from the asset in which you are investing and the return from the market divided by the variance, which was return from the market. Then comes the expected return from the market. Is right now I told expected return from the market is like so looking at the market movements and the prices, you decide what should be the expected return from the market, looking at the trend in the past years, all those factors. And then there is market risk premium. So market risk premium is nothing but when you deduct the risk-free rate from the expected return from market, whatever extra you are getting as return, if you have not invested in the lower risky, the secured government bonds, and you have invested in equity as an option you by taking higher risk, so you need to have certain premium. That is the difference. We are here looking at the difference. That difference is actually the benefit which you are getting by not investing in those government secured bonds and investing in the equity market. So let's have a look at one example. Suppose there is a 10-year government bond which yields you a 7% rate of interest per annum. So what this 10-year government bond would be? It would act as a risk-free rate because you know that if you are not investing your money in equity market, you are having an option to invest your money in the government bonds, which is much more secured. But it would yield you 7% and it would help you in coping up with the inflation rate. It would at least help you in coping up with the inflation rate and would maintain the purchasing power of your money. The second is the expected market return. So let's assume it is 9% what you are expecting from the market, and the beta value, let's have it as 1.2. Let's see the market risk premium. So it would be expected market return minus risk-free rate, which is 9 minus 7 equals 2%. And when we talk about the expected return from investment, which our CAPM formula was, this what we wanted to calculate. So this is risk-free rate plus beta into expected return from market minus risk-free rate. In simpler words, like we are adding the beta, we are adding the market we are taking into consideration the risk-free rate and we are adding the beta value into the market risk premium. So we got the value of 7% plus 1.2 into 2%, that is 9.4% as our expected return from the investment when the government bond was yielding 7% and we expected market return was 9% and the beta value was 1.2%. So actually this is the expected return from our investment. So it's quite good. It's 9.4%. So thank you for watching, guys. This was all about this video. I hope you liked the video. Do like and share my videos. Subscribe to my channel, DevTech Finance. Thank you all.